Today we are going to do a little bit of Pioneer Academy with a special focus on stock options. We don't have too much going on today with Tesla in the markets. It's pretty quiet, Tesla barely moving. So that's why we are taking the time to focus on a little bit of education and discussions. I'm a little bit exhausted, but I'm doing my best to answer these questions. I'm working very hard on the Pioneer bonds. There's exciting things coming up in the next few days. But let's go to the questions. Go to pioneeracademy.com or pioneerlands.org to also ask questions. And today we are focusing only on the very exciting topic of stock options. So we have 4 questions in total, some of them very complex, or at least the answers will be very complex. I'm going to try my best to respond. Let's start with the first one by Eliel, a citizen. Very important. Citizens get preferred treatment. So thanks, Eliel, for your question. Your latest video on leaps. The purpose of going through these questions is to explain how I apply Pioneer Alpha, how we are able to outperform Tesla, even though we are very focused on Tesla, by using 2 different strategies. Alpha churn and alpha roll, or the leap strategy. Churn is all about selling short calls and puts, mostly puts because we are bullish. So out of the money puts most of the time, sometimes in the money puts. That is mostly a strategy that is very helpful for sideways movements, because when you're selling options, you sell them short term, short expiration dates, weeklies, with maximum churn. So if Tesla is 410 or 411, you're selling 405 or 400 puts that expire in 5 days, and Tesla doesn't fall below that strike price, you just collect the premium all the time. And if you're bullish and have a strategic outlook, you can keep doing this and constantly make money, even if Tesla goes slightly down or sideways. And of course, if it goes up. So that is a very good strategy, but this is not the topic of this first question. This is about the leaps. So for those of you who don't know, leaps are long-term out of the money calls, mostly out of the money. You can also do in the money. So the idea of leaps is you're basically locking in an out of the money strike price. Tesla is 410. You, for example, say, I buy a call option that expires in 1 year or in 18 months, like a long time out for minimum time loss. And you're buying a high strike price like 600. So you will lose all your money if Tesla doesn't go above 600. Sounds risky, but if you're bullish, 18 months from now, 600 seems like pretty much a safe bet. And then you pay a certain amount, like $50 for that option, which means if Tesla goes to 650 by expiration, by mid of 2027 or whenever the expiration is, if you pay $50 for 600 expiring 2027 mid of the year, then at expiration, Tesla has to be at 650 or higher for you to not lose money. But if it goes to 700, you make 100%. If it goes to 750, you make 200%. If it goes to 800, you make 300%. You get it. And of course, at 800, you wouldn't make 300% if you buy the Tesla stock. And then the higher it goes, the exponentially more you make. So that's the idea of leaps. And normally if you buy leaps, if Tesla goes up after you buy it, you tend to make more money. You have a higher capital delta. Very important. I call it capital delta, which means the amount of money you make per capital stock compared to Tesla. So if you sell $100,000 worth of Tesla stock when it's down and you roll it into an out of the money call, and right after Tesla starts going up, the 100,000 you moved from stocks into the OTM out of the money calls tend to have a much higher return, like often, 2x higher than Tesla. That is not to be confused, by the way, with the delta of the stock option. It's a little confusing for people. So if you buy one call option, it has a certain delta. The delta describes if Tesla goes up 10%, or if Tesla goes up $10, how much does the stock option go up? Does it also go up $10? But that's a confusing delta because that's not really helpful for you. You want to know if you move $100,000 from Tesla stock into the option and Tesla goes up 10%, how much does this 100,000 in the option go up? That is the delta I'm looking at, but that's normally not called delta in options. But that's what you want to know. And normally that's like if you go out of money, roughly around 2x. So bottom line, That's the leap advantage, and leaps are normally very advantageous over margins or other ways of leveraging up for a simple reason. They have one disadvantage over in the money short puts, for example. It's another way of being very bullish to the upside. And over margin, where you just borrow to buy more stock. And these are all kind of the same thing mathematically. You can transpose them into each other. They're all doing the same thing, but with a different risk profile. So if you do deep in the money short puts or margin, as opposed to OTM calls or leaps, the disadvantage of the leaps is that you lose money, whereas with short puts, you make money when nothing happens, right? So basically there's a time value you're losing. So that is the big price you pay. Big advantage is, compared to the other two, you don't have margin squeeze risk to the downside. So if you buy an out of the money call and Tesla drops 50%, sure, you're losing massive amounts of money on paper, but nothing can really happen to you. You can just keep that thing forever. Whereas if you're short in the money puts or on margin, you get destroyed. You actually are getting forced to sell and close these positions at massive losses, and it's very hard to recover them. So the big advantage of leaps that you pay for with your time decay is that you are always safe to the expiration in terms of being squeezed out. It cannot happen to you because there's no pressure, right? So even if Tesla drops from $400 to $10, it doesn't hurt your leap position in the sense of getting squeezed. Of course, it loses 99% of its value on paper. But if Tesla then bounces back to 800, you still make the exact same amount you would have made if it wouldn't have dropped down in the meantime. But with short puts or with margins, you're dead. You can't recover because it forces you to close everything at massive losses when you lose. So that's the big advantage of leaps. You can sleep well as long as in the end you're right about the price point in 18 months or whenever the expiration is, you're safe. So long story, that is why leaps are so attractive. Now the question is, one point needs clarification. Why do you miss out if you sell 440 short puts and Tesla goes up to 480? In this case, you would just keep the premium and your core position goes up as well, right? Exactly, you're right. So Eliel is correct that you keep your entire premium, right? If Tesla is at 410 right now, for example, you sell 440 short puts, right? The way to visualize that is you're basically taking on these short puts and they pay you whatever they pay you, maybe depending when they expire. They expire, let's say, in 2 weeks. So a 440 short put probably pays you like $2 premium, not much, maybe $3 if you're very lucky. So you can do the math. If it's at 410, let's say Tesla today, at 440, you get $30 right away because that's the differential. So you're selling them short, you get cash into your account of $30 or 3,000 if you take it, like each contract is 100 stocks. So you get $3,000 into your account plus a little premium. So probably 3,900, I don't know. You basically get $33, yeah, 3,900 into your account. And if Tesla then goes up, you're effectively completely long, these 100 shares, right? Because now every time you always have to think about when Tesla goes up 10, how much does the stock option go up? If you're short puts in the money, they just keep going up more or less the same all the way to the strike price. I simplified at expiration. Now, when I say you're losing out, if a Tesla goes to 480, here's why I'm saying this. If you take on short puts, you're taking on, let's say, greater amounts of risks compared to long calls in terms of what happens if Tesla drops, right? So if you do that, the question is what would have been your alternative, right? If you were basically in the channel trading. And whatever strike price you choose for your short puts, that gives you kind of your anchor point. So if you're the perfect trader, options, like directional options trader, you basically want to always nail the short puts to hit exactly the point the stock ends at expiration. Let me explain why. Because if you have a 440 short put and Tesla actually ends at 440, you got the best of all worlds. You got the maximum return out of this thing. Because, and that's how you have to think about it. if Tesla is at 410 and you're selling a 440 short put, which would be very crazy, I'm doing it right now on a little bit because I want to lever up, but most of my short put positions are not that. What's the downside of doing a 440 put? The downside is that your time premium is tiny, right? You probably get $2, whatever, for 2 weeks. So you get $32, which means if Tesla goes sideways, you're only making $2 for significant risk you're putting on, significant margin that this whole thing eats up, right? So if Tesla ends up at 415 instead of 440, you would have been vastly better off selling the 415 short put, right? Because you would have gotten much more premium, right? So if Tesla is at 410 and you're selling a 415 short put that expires in 2 weeks, you probably get, at 415 and 410, you probably get whatever, $5, $6, $7 premium. So if Tesla goes sideways and stays at 410, that's what you have to simulate. How much money do you actually make with a short put? If nothing happens, if Tesla makes zero, how much do you make with a short put? Well, with a 415 put, you make massively more, probably 300% more. You probably make $6 instead of $2 compared to the 440, okay? That's what you have to think about. You have to think about how much premium do you get. The $15 short put pays you probably, let's say, 10 premium. The 440 pays you 32 premium. But if Tesla doesn't move and stays at 410, the 32 are worthless because you are only keeping 2. You're only getting $2 in free money. Free money meaning what you get beyond the current price. Whereas if you sell a 415 short put, you get probably $5 instead of 2 south of the current price. Which means if nothing happens, you're getting free money, $5 for the same level of risk and margin. Or you're getting only $2 for the 440 if nothing happens. Why would you ever do that? Well, because if you're more bullish directionally, the maximum payout of the 440 short put is, of course, much better. It's 32. But in order to make 32, the stock needs to go all the way up. Now, if Tesla would go up to 480, then selling a 440 short put was kind of in hindsight a mistake because you should have sold a 480 short put. Because you make $32, right? And you have this $2 premium, you would have been better off taking a 10 cents premium, but getting $70 and 10 cents premium. Because now you make $70 and 10 cents premium. You understand? What you are basically doing with these deep in the money short puts versus at the money or a little bit in the money or out of the money is you are exchanging risk with, potential loss of return. That's what you're balancing out. So in an ideal world, you know where the stock ends up. And that's exactly the short put strike price you want to choose. Unfortunately, of course, we don't know where it ends up. But if you have any kind of feeling about the direction, you become perfect. The closer you choose the actual put strike price in expiration, where the stock actually ends up. That's always the premium maximizing move. So if you know Tesla ends up at 480, you have to sell short put 480 strike. If it ends up at 440, you have to sell 440. Because if you sell anything else, you're underperforming. Right? If you sell 440, it goes to 480, you lose massively out. You would have made $40, which is an insane amount, more if you would have sold short a 480. If it ends up at 410, you're at 410, it ends up 410. The maximum premium you would have gotten is selling a short put at 410 strike price. Because if you sell 440, you only get $2 beyond the 410. With the 410, you probably get $7, $8, $10, right? If you would sell a 405, like way out of the money, that's a whole different game you're playing. If you sell out of the money, of course you're basically slightly bearish, or at least you want to buffer risk. You're basically saying, I rather make $5 in premium for a 405 out of the money than $10 premium for a 410, and if you're currently at 410, because then you have to do the math. Out of the money range plus premium, that's your buffer to actually losing money. So if you sell a 410 put strike for $10, then Tesla has to fall to 400 before you start losing money. If Tesla ends up above 400, you made money with this trade, okay? You're selling 410 strike price, 1 week expiration. You get $10, which means all the way to 400 you make money. At $3.99 you start losing money. If you would sell a 405, you probably get $6 or $7 premium instead of 10, right? 410, you sell 410 strike price, you get $10 premium, which means at 400 you start losing money. If you sell 405 out of the money, you probably get, let's say, $7. Okay? Again, if Tesla doesn't move and ends up at 410, then the 410 strike price was the right choice because you made $10, not 7 with the 405. But in return, you're getting more risk buffer. You're making less premium if things go sideways. But if Tesla falls to 398, you are still green or neutral with the 405. So you buy yourself $2 more buffer to the downside, which over time, it's all about estimating where it could end and what the distribution probabilities are. If you think it's very risky, for example, if you think, I really have no idea what's happening, there's enormous tail risk and everything, and we have to be prepared for a major drop, of course you want to go way more out of the money or even not touch short puts. But if you think, even if bad things happen, it's not going to go under 395, you can sell a 400 strike price at $5 premium or something, then you get to your 395. So that's roughly the rationale here that you have to consider when you make these decisions. So you kind of just have to always think in future scenarios with options. Whenever the expiration is, what do I think where we end up? And then you have to do basic math. Like if you end up here, what happens with this? And then it's simple math, right? You just add it up. You always look, where's the strike price? How much premium do I get? And now let's do some math. Why would I sell a 440 short put if I could also sell a 480 short put? Because you get $40 in additional potential upside if the stock rallies. Well, you would do that because the 440 pays you more premium. Premium means free money if you go sideways. Free money buffer to the downside. Probably not much. 440 probably pays you $2 below your current price, and 480 pays you 10 cents. 440 only gives you $2 additional in churn value, but takes out $40 in additional upside. Now this is actually balanced because the probability that these $40 come into play is very low. Right? What are the odds we are ending next week at 480? Could happen, but it's extremely unlikely. And then the question is, if you do this 20 times, your $2 every time add up to 40. So is it more likely that for 20 times this doesn't happen? Then you're better off selling for 40 short puts. Or every 15th time it actually goes to 480. Then you're better off selling 480s. That's how you have to think. So I hope that was a little bit of an insight. I'm happy to discuss this more. I hope we are definitely boring everyone who's not into options here, but that gives you like a feel for things. So thanks a lot for this, Ilel. Let's see if we can answer one more options question here. Mark, now I send it down here. Let's go back. Mark is asking, after watching your latest video on leap options, I have a few questions. Is it more beneficial to purchase the leap as close to the inflection point as possible, or try to purchase the leap when the stock is as cheap as possible? That's an interesting question. So basically, Mark is asking, well, there's a little bit of a fallacy in this question, but he asked, okay, is it better to wait until Tesla drops like crazy and then roll stocks into leaps? Or is it better to wait until the inflection point is very close, in your opinion, and then buy leaps? Let's say Tesla drops to 360 and way cheaper than this. Do we buy then because we think the cheapest stock will be inflection? Or do you think, okay, well, there's still 2 more months to wait, blah, blah. Okay, this is a tricky question, but basically you shouldn't think in, is the stock very low or is the inflection point very, very close? You have to always think in probabilities and your conviction levels. And what you are looking for when you buy leaps, you want to basically buy leaps when you think you have the maximum upside in the minimum amount of time, or more realistically, that the strike price out of the money that you're aiming at has the highest probability of being achieved in that time to expiration. So for example, if Tesla drops like a stone to 220, like with these crazy tariffs, for me it was very clear that we have a V-shaped recovery for many reasons. I explained this when it happened. I said like, this is the joke. So every time you think the stock has either overly sold off or is getting very close to a major run-up, which is technically the same thing. So you basically have to ask yourself the question, is the stock close to a run-up very likely? Or is the run-up extremely likely to happen in the next 6 months, like significantly within the runtime of the option? Ideally in the first half of the runtime, not in the second, because then it gets nasty. So you have to basically ask yourself, is there a major run-up coming in the next 6 months if you have an 12 to 18 months leap? And a major run-up can happen because of two reasons. It can be the inflection point. We are at 400, we go to 1,000, or we are at 400, we go to 800 or 600. Or we had a major drop. But a major drop also means you don't buy because you have a drop. You buy because you see a run-up coming. So if a stock drops like a stone, there can be many reasons for that. So the fact that a stock drops is not a good reason to buy the leap. The reason is that you think, well, this has to end up in a major run-up. Maybe it's a recovery run-up, a V-shaped recovery, or it's just a run-up based on a certain base and something crazy happening. So don't ask yourself, oh, the stock has dropped, should I buy leaps? No, you have to always forward-looking, will there be a run-up? In the specific case where the stock dropped like a stone in April in Liberation Day, I knew there's a run-up coming because the stock was massively undervalued and it was all fake news. And then we needed to see a run-up. So I didn't buy the stock because it dropped like crazy, technically. I bought the leaps because I saw a major run-up coming. Now that run-up happened because it dropped so much, but that's a special situation. So basically forget about, you always have to be forward-looking with leaps and say, when do I have very high conviction that the stock has to appreciate dramatically over the next 6 to 9 months if you have a 12 to 18 months leap. That's the point where you roll stocks into leaps. That's the point where you want to double down into leaps. And why this can happen, there are multiple scenarios. One is robotaxi, like a forcing function coming that drives the stock up, or a major drop where we know the reason for the drop will be, out of scope very quickly. Okay, second question. Let's say we get to around the 8-month mark, half of our 60-month leap, and like you say, we are down 30%. If you're still confident that the price inflection point is just around the corner, sometimes with our contract period, but we are just still not sure quite when, we'll be able to sell the leap at a loss and roll into a new one. Again, very important, always be forward-looking. No one cares how much you're down. No one cares about anything because you're not taking a loss when you roll over. You're rolling it over. What you're basically doing is you are giving up a little bit of upside, not much. You're giving up a little bit of upside if you roll into another option that is 12 months longer runtime, right? You're just giving up a little upside. In my experience, buying yourself safety and reducing risk is always the right choice. Not giving up your upside, buying yourself more time. So you have to always think in scenarios. So if you're down 30%, who cares? If you're sure what you predicted will happen, but buying yourself more time can be very valuable. The reason is you still have 70% of value left. And if you enter this nasty 8-month, I would say it starts at 12 months. I do not feel comfortable holding anything lesser than 12 months runtime because it really starts to accelerate the losses, time losses, very brutal. So 30% down for leaps, that's like peanuts, no one cares. 50% still half peanuts. 60, 70% gets a little nasty. So at 30%, you're totally golden in my opinion, as long as the thesis holds. And 8 months, you're not golden. 8 months is, I don't feel comfortable with that. Now, do I have relatively high confidence that Cybercab, for example, and Robotaxi will scale in the next 8 months? Sure. But I'm vastly more confident over 12 months. Like vastly. And I also know every month now has a much higher time decay, so I don't like it at all. Depends also where your strike price is, right? So if it's 800, I would be a little scared. At 8 months, you're taking massive time decay losses, so I don't like it. I would roll it over because then you can sleep at night, right? So what's the harm? If you're right, you will still end up with 100, 200% plus. And if you're wrong, then it's definitely better to have a longer runtime because then you're totally dead if you're wrong with this one. So I would look at time decay. I would not be too greedy. If you have a little losses and roll it over and make less money, who cares? It's always more digestible to make a little less more money than looking at major losses. That's how I would think about it. Because this is not about taking losses and selling low or anything. This is just rolling it over and buying yourself more time to have the thesis play out, and always run the numbers. The numbers are not hard to run. If Tesla ends up at 600 or 700 or something, where does my leap end up? That's what you have to do. And then you do the math. It's very easy. Google Sheet. Okay, this strike price, this is premium. How much money do I make above the premium? And then you consider the risk you're taking. Okay, if this doesn't happen, I'm totally screwed. If you have a 600 or 700 strike price leap that expires in 8 months, in November or whatever, in October, I would not like it. I would push it 6 months or 9 months out. Because the worst, greed is very dangerous, right? You will be very happy with what happens if this goes up. And then saying, oh, I could have made 900% instead of 200 if I would have done this and that. Well, yeah, sure, in hindsight, but you could also have lost 100% easily. So I am playing for safety with these things. Last question. Wouldn't rolling leaps at a loss always end up worth if the stock eventually inflects? No, I don't even have to read the example, but that of course depends on the numbers. Of course not always. The way I'm seeing it, since we are strongly convinced the stock will be 600, 800 plus in the eventual near future, well, but when is that? But we are just not sure exactly when. If we buy a 540 leap 16 months out, it would cost 7,000 per contract, so probably $70. $70 premium times 100. So you need to hit 610, 540 strike, because at that strike, getting it to 600 break even. Getting 610 is break even. Getting 650 is break even on what our shares would be worth, if you say yes. Getting to 750, we triple our money and make 14K profit per contract. If we misjudge the timing, we can sell the 8-month mark for a 30% loss. If we can sell at the 8-month mark for a 30% loss and roll into new leap, fresh 16 months. This costs us about 2,100 per contract in losses in doing this. But when we finally get the window right and the stock does go to 750 gains, finally get our inflection window. When the stock finally does reach 750, it becomes worth it. And should the stock go higher to in our ultimate leap window, we could make gains. Wait, let me understand this question. If we misjudge the timing, we can sell at the 8-month mark for 30% loss and roll into a new leap. That is correct. Yeah, that costs us money. That is correct. But when we finally get the window right and the stock does go to 750, the term will be made up. That is correct. Even if we had to roll over leap over 2 or 3 times to finally get our inflection window. That's correct. When the stock finally does, that is all correct. So I don't understand the question. The bottom line is, exactly, you're taking some losses and that reduces returns, but you will always easily make this up in terms of actually making money by rolling them over. Okay? So you are basically asking the question, if I roll it over, if I decide, I don't like it, I roll it over, but then the inflection actually happens, would you have made more money if you wouldn't have rolled it over? Of course you would have made more money, but you can't know that. So that's how you cannot think. You cannot think like, oh, I want to roll it over to buy more time, but what if it turns out I didn't need more time? Well, then, yeah, you made less money than you could have had, but that's called risk mitigation. You can never think like that. That's a huge mistake. You basically have to be very happy if that happens, okay? You have to always, this is very important in investing and in trading. If you make a decision, you have to understand that you're paying for risk mitigation. And you have to also understand that in every single case, you always over-mitigated risk. You always paid more than you should have had if you had perfect hindsight vision. But that's totally okay. That is not a mistake. That's exactly the right thing to do. You're buying yourself safety that you for sure won't need if you do it right. You will always over-purchase safety. You will say like, oh, I only have 8 months left. That's too scary. If it happens within the 8 months, it's perfect. But if you push it out, you buy yourself the safety. What if it doesn't happen the next 8 months? Well, then you survive and still make a lot of money. Otherwise, you're dead. If it then happens in month 6, you can't go back and say, "Ooh, I wish I wouldn't have done that," because you have to look into the future. You have to ask yourself, well, was it knowable? How safe was it? And the most important part is, the true measure of your success is, did this whole leap situation that you did make you more money than holding the stock? If the answer is yes, you win. You have to compare yourself with the stock because this whole leap strategy is about tactically deploying options to make alpha. If in the end it turns out you made alpha, you are a big winner. You cannot compare your option strategy with an alternative option strategy that was unknowable that made you more money. That's deadly thinking. You can't do that. You have to assess yourself against 100% Tesla or position, right? Whatever money you want to allocate into Tesla or whatever stock, but Tesla, if you take some of that out and turn it into options, you have to measure yourself against if you would have stayed fully invested in the stock, would it have made you more money? And if the answer is yes, your options trading sucks. But if the answer is yes, you made more, then you win. That's how I approach options. For me, I'm not an options trader. I'm someone who systematically generates alpha over Tesla. And that is actually very helpful because it makes you less greedy. It tells you, well, all I need to do is deploy options on the fringes of my Tesla position that ensure, in my opinion, that I will always make more money than being 100% in Tesla. That is very important to understand. I only want to be absolutely sure and always make more money than a full Tesla position. What do I mean with that? That is all I want. That is all I want. That's the win for me. So if I have the choice of making more money, significantly more money over a full Tesla position versus making much more money over a Tesla position, but taking significant risks to make less money than my Tesla position, I will not do that. I rather take 10% or 20% alpha over a full Tesla position with high levels of safety and certainty over a 50% alpha over Tesla with some crazy risk. So basically, the first thing I do with my option strategies is always I have to think through, like, can I be sure, as much as you can be sure, that I will always make more money than with full Tesla exposure? That's my benchmark. And if I ever think like, I am not sure, this can go really wrong, and then I will underperform Tesla, I will have negative alpha under Tesla, I don't like it, I don't do it. So I think that's a very healthy approach because it, curbs your greed, because you know why you're doing it. You just need to beat Tesla, but you make sure you beat Tesla. And then you quickly learn, like, let's not do crazy things here, because if they backfire, I look like an idiot. So it's very healthy to compare yourself, to ask yourself this question when you assess risks of leaps. Otherwise, you get carried away by greed, and greed always kills. If you just have unmitigated, unhinged greed, you will get killed. It's very simple. You need to anchor it in something, and the best thing to anchor it in is the underlying core equity and stock. That brings a little reason into the whole thing. Okay, that's it for now. We will cover the other two questions later. That was already pretty long. I hope that was interesting. That was a little options nerding out, but important questions. So go to pioneeracademy.com or pioneerlands.org. Ask any question. Today we did options, but there are many others. You can ask AGI, robots, autonomous vehicles. So we have fundamentals here. We have macro politics, culture, geostrategy, and economics. And of course, Pioneer Lands. If you're interested in the future, you can ask about the Pioneer Academy, the Pioneer Reserve, Pioneer cities, and all kinds of things. So these are our four big themes: wealth management, your portfolio strategy, your options strategy, and of course, stocks directly, Tesla, NVDA, and so on, Robinhood. Check it out. It's all free. If you want to become a citizen, of course, you get preferred treatment, and we have private chats. We also have a citizen seminar coming up very soon where only citizens can ask questions and all questions will be answered. That is a new feature coming up next week, by the way. And the new secret research core, where we will forge the future through a new sort of scientific inquiry with the pioneers, also coming up probably in 2 weeks. So stay tuned. I hope that was interesting. Ask your questions and we will get them all answered. See you tomorrow.